So continuing on with the savings plans, it's the breakout of what's available to you at a typical, again, a retail bank or a depository, credit union, savings and loan, et cetera, would be a regular savings account, which has um, very has a low or minimum balance that you could start up a savings account, right? Pretty straightforward. The CD is it's what's called a certificate of deposit, and it's a savings deposit, if you will, where you would set up times that you would have on deposit, so you were required to keep it there for 3 months, 6 months, 1 year, up to 2 years. And for doing that, for setting aside those funds for that length of time, you end up with a bit higher rate. Money market accounts are, again, it requires a minimum balance, and the idea is, again, that you're getting some rate of return um, on those funds. It's not you have to have a minimum balance. Required minimum balance may be of $500 or $1,000. You can take the money out, but again, you're required to keep a certain balance on hand. Typically quite low. This is all cash management. You're not going that long, except for the CD, where you're looking at 2 years, but it can go out to 2 years. Typically, it's much less: 3 months, 6 months, 9 months, 1 year, typically at most. Lastly, with the savings bonds are again are low risk. This is you're buying into, in effect, U.S. debt. You're lending money to the government for longer periods of time in order to receive a relatively low rate of return, but there's low risk. In fact, U.S. Treasury, investing in U.S. Treasury securities, bills, notes, and bonds, um, that's typically viewed as there would be zero risk so far as default risk, so far as credit risk would be is concerned, but that's for another discussion. So, what you choose at these depositories, for example, it kind of drives whether what depending upon economic circumstances, et cetera, what it is that you're to meet your required rate of return. For example, the first thing is that the longer, again, that you're away from your money, the higher the rate of interest in general that we're talking about, right? Inflation obviously has an impact on your desire to hang on to cash, for example. And times there's a lot of inflation, you want to move away from cash because you're not getting any interest on that cash, right? Taxes, you want to try to do what you can to reduce your tax burden, because this is all part of what you're paying, reducing your rate of return, liquidity, how accessible your money is, and without the penalty. So whereas you can withdraw the money from the CD, the problem is you will not be receiving the full rate of interest that you would otherwise be receiving. Safety, again, there's a deposit insurance, $250,000 per savings account, for example. Anything that you have savings or checking account in a bank through the FDIC, the Federal Deposit Insurance Corporation, restrictions in terms of fees, minimum balance limitations, et cetera. All kinds of different criteria that are out there for you to consider when you're looking for savings. So speaking of required rate of return, or more specifically about the rate of return, we're looking at how much interest you would be receiving, interest earned, if you will, over a period of time. And so typically when we talk about interest, we're looking at compounding interest. So for example, if you have something that's out there for if you're paid 10% annually for your $100, so the first year you get the $100, you have the $100 and you tack on $10, you end up having what, $110. And so the next year you're going to be getting 10% interest on that $110. So the following year you would be getting another $11, so you would end up with what? $121. This is the beauty of that compounding. So the higher rate of the more frequent the compounding means the higher rate of your return. So if it's annual, quarterly, daily, etc., right? So truth in savings defines that annual percentage yield, how much you're actually getting as a saver, if you will. So the formula for APY is 100, for example, times that interest divided by the principal. Note the formula is applicable on a number of days and the term is 365, or when the account does not have a stated maturity. So we're typically looking at this on an annual basis, right? So interest on a $66 on a principal of $1,200, 100 times 66 divided by the $1,200 gets us to that APY of 5.5%. Again, pretty straightforward, but very powerful nonetheless. So the thing that we really always want to pay attention to are taxes, right? It's always, it may not be the primary source of concern for us, but it's something that we want to pay attention to because we're looking for that after-tax savings rate of return. So if we want to determine what your top bracket is for federal income tax, because that is the end, you're going to be paying in, it's going to be reducing your rate of return based on that, if you will. Subtract this rate expressed as a decimal from 1, multiply it by the rest. So the example again, you're in the 24% tax bracket. So you take 1 minus the 0.25, and that gets us to that 0.76. And if the yield on your savings account is 5%, or 0.5 in this case, times the 0.76, you have an effective rate of what? Of 3.8%. Your after-tax rate of return is 3.8%. So this is, again, simple but very, very powerful. So you're looking at what your actual yield is going to be. In this case, it's going to move from, your rate of return is going to go from that 5%, stated 5%, down to 3.8% because of the tax ramifications, right? Your tax liability. Always, when you're looking at a bank or depository or wherever your funds are located, you want to make sure you consider what the restrictions and what the fees are that are associated with it. So if you have a low balance, for example, you may end up with a monthly maintenance fee, inactivity fee if no deposits or withdrawal occur within 6 months. Again, depending upon the banking or credit union or whatever that you're talking about, there's oftentimes fees that are kind of hidden fees that you don't realize until they hit you. So again, if you transact more than 6 withdrawals during a month, there could be fees associated with that. That's kind of gone away, but nonetheless, there's still possible things like that could be in force out there. Wire transfer fees, etc. Because again, any kind of services that you're getting from that bank, there's a cost associated with that, or there can be. So again, speaking of fees, there are fees that are associated with various accounts, whether we're talking about checking accounts or whatever. There can be fees associated with that, and not just based on balances, but it could also be on the transactions themselves. If you're using your debit card for transactions, there may be a fee associated with that. There could be a fee associated with prepaid debit cards. There are lots of different fees that could result from having, again, a checking account when you go below your minimum balance amount. Fees that would be on there are also a variety of other possible benefits, if you will, from having like now accounts, interest earning checking accounts. That's the negotiable on withdrawal. The now is with credit unions, share draft accounts, and again, that's usually have some sort of a minimum balance, but nonetheless there's some interest that would be paid to you on that. So there's some minimal amount, but there's something. So the different electronic payments available to you, debit, online payments, mobile transfers, the prepaid cards, using, accessing your smart cards again through your phone, where you're paying directly from the phone, checking accounts, regular checking account, activity checking accounts, interest earning checking accounts like the Now accounts through share drafts through credit unions. Other payment methods include certified checks coming from directly from the bank. So these are drawn on banks and going all the way down through to traveler's checks, which are pretty much non-existent, but they're still out there available. So checking accounts are pretty straightforward, but you need to evaluate this, see what fits the bill for you. Whether there's a minimum deposit that's required in your checking account to avoid service charges, overdraft protection, which is something that's constantly out there. If you have $50 in your account, you write a check for $100, you are over by $50. There are typically charges that would be associated with that, or the check might be returned. There's some return check cost, and so on and so forth to do these things. But these are constantly changing. The regulatory environment is such that all these things are under consideration. But so anyhow, when you open a checking account, you decide whether it's going to be in your name or maybe perhaps with a spouse or somebody else, a joint account with someone else, and making the deposits. And all this is done remotely now, pretty much, but you can still do this, walking into a bank, into your local financial institution and deposit a check. And there's criteria that go along with it, but it's pretty much spelled out where you endorse the check on the back and deposit it into your account, right? So this is old school when we talk about writing checks, because no one writes checks anymore. I have to admit that I'm down to writing maybe one check, depending upon the circumstance, one check every week, maybe every month, actual physical checks. But it's the same idea when you're using it online, using your debit card. It's the same idea that it's basically a checking account. So anyway, aside from the checks that mentioned, they've been talking about here, checking accounts, other payment methods would be a certified check, coming from the bank. The bank actually draws the check upon themselves, so they're the guarantor. They're the ones that guarantee the payment for that check, and they withdraw the funds from your account immediately, and then it's whoever you write the check to, it's the money goes directly from the bank to them, not from you to the bank to them, but directly from the bank to you. Cashier's check, very similar again. A check from the financial institution, money orders, similarly, you purchase these at a financial institution. Money transfers, traveler's checks are so money transfers, again, that would be through Western Union, etc., where you send those funds on electronically through that Western Union, etc., onto other people. So traveler's checks they're kind of they were used very frequently in the past, not so much now, but they're used still. And basically what it is that you have a check that you sign, and then you have to countersign that when you actually use it. All right. So you take possession of it, but you've got to sign it again in order to actually do the transaction.